Hello and welcome to the FT headquarters. Today I have with me Patrick Mange, Head of APAC and Emerging Market Strategy at BNP Paribas Investment Partners. Our subject for the latest video in the expert series is investing in emerging markets. Everybody today is talking about China, Chinese growth figures. The government has a marginal argument with other authorities in the country, whether it's 7.2 or 7.5%, but other people outside the country are saying even those figures are too high. Maybe one of the investment banks this morning was saying that the growth figure is actually 2% less than that. Are you worried about these measures of Chinese growth? In reality, it could be much less than we're actually being told?
Yeah, I mean, I saw these papers. They are based on some correlation on electricity consumption and kind of what they call the Li Keqiang indicators. And they hint at something which is slower growth than currently officially published. But okay, I mean, I think in many of the emerging markets, you would have this questioning behind, not just in China. I tend to believe in the official figures. What is really striking is that even at a 7% growth, even at a 6% growth, even at a 5% growth today, China would contribute more to world growth than it did 10 years ago with 10% growth. The Chinese potential growth is about 7 now. So a growth rate at 7 is fully sufficient for China to relocate the resources properly, not to have a slack in unemployment, for example, which is one of the most important things for China on a social side. So basically, I'm quite positive on China. The market believes that the reforms are behind schedule. We believe that reforms are at schedule, if not a little bit ahead of schedule for some areas. So, and it's going in the very right direction. It's more market. It will be more market-oriented. And there's a deregulation which is very sound, and an anti-corruption task which is very sound for the longer-term sustainability of the economy. A point to mention here in particular, I believe, is the SOE reforms, state-owned enterprises reform, which probably will generate much more productivity moving forward. So at current stage, margins are quite compressed due to this SOE. So basically, if there's a big reform here, if they allow private to enter the SOEs more than before, which is the case, and which has been the case for some companies already, then probably we'll have more productivity, better profit margins, earnings going up, and the market reacting to that.
But what are your biggest fears about China? Is it problems to do with the property and construction industry, with the construction activity affecting so many other parts of the economy, or is it the shadow banking scare stories that we've heard about so much?
It's probably related, to be honest, because construction and shadow banking, there's some links. So yeah, that's probably the biggest scare, that this goes out of control. At the time being, it seems to be well controlled. But again, this is something which can derail at some stage and which would probably trigger the hard landing that people are speaking about for quite a long time now in China. My central case would be that the Chinese authorities, they are watching very closely to that, because they're very conscious of that risk, will interact if they see that's going too far the negative direction, as they did in the recent past. So they have a lot of leeway to counter any phenomenon which would endanger financial stability in China. 40% of savings rate, 4 trillion plus of currency reserves is quite a buffer to do something, particularly if you have a very regulated economy like it is the case still for China.
And can you tell us, Patrick, how much influence does the Chinese economy have on the other developing markets, and how much of the indices are actually made up of Chinese stocks?
The weight of China in the MSCI is quite heavy. I think it's around 20% now. So yeah, this is a big influence on the index side. Now, China has a psychological influence as well, in my point of view. It's a little bit maybe strange to say that. But China, meanwhile, is the second biggest economy in the world on purchasing power parity terms. If China is not doing well, that is impacting world growth, not just impacting emerging market growth. Many emerging markets are very geared to growth because they're exporting countries, they're manufacturers, and they're commodity producers. So it's very depending on a good state of the global economy. So if China is not doing well, the world will not do perfectly either. And that is how China probably influences the rest of the world, and through the weight in the index, in the MSCI emerging markets, influences as well the index. Psychologically, if people start to think, okay, China is not that bad, there's less risk of hard landing, earnings growth is going to be positive, at least according to the consensus at the time being for 2015, more positive than it has been in 2014. It was not negative in 2014. Then that might be one of the triggers for emerging markets to move up again.